Hi, good afternoon, and welcome to our web event this afternoon addressing the anticipated student loan cliff. We are calling this event today Bracing for the Student Loan Cliff and discussing what comes next for borrowers and the federal budget. I have with me today a really fantastic group of experts here to walk us through exactly what's happened, what it means for borrowers, what's to come in the policy realm, particularly on student loans and addressing this issue of default for borrowers. If you're tuning in today, you're probably familiar with the fact that we are about 1 month out from the Department of Education announcing that they will resume collections activities on defaulted federal student loans. We haven't seen collections activities on these loans since the end or the beginning of the COVID crisis and the associated economic downturn. So this marks a massive shift in policy with really massive implications for borrowers. Let me introduce the friends that I have here today to talk with me about this issue. First, I have Alex Ricci, the president of the National Council of Higher Education Resources. Next, Sarah Sattelmeyer, project director at New America. And last but not least, my colleague and senior fellow at the American Enterprise Institute, Preston Cooper. Thank you all so much for joining me for this conversation.
Thank you for having us. Excited to be here.
Absolutely. And I will add to this, this is mostly going to be me asking you some questions to learn about what's happening here, but we're also inviting audience participation. So there's two options for audience to submit questions here. First is on X or Twitter. That's with using the hashtag AEI Loan Cliff. Alternatively, you can email Anna Coulter, ANNA period COULTER at aei.org with your questions, and she will get those to me, and I promise to sprinkle them in throughout the conversation today. So let me just start by offering up the question to the group. We've had this massive shift in policy. What are the immediate implications going to be for borrowers?
So it's important to remember that borrowers don't go into default for 270 days after they last make a payment on their loans. And so the student loan payment pause effectively ended in October 2024, which means that borrowers who entered repayment, after the student loan pause ended, will not default until sometime over the summer. That's when the first of those borrowers will start rolling into default. The immediate implications are probably going to be most dire for the 5 million borrowers who are currently in default right now. And those are generally people who were in default before the pandemic and have probably been in default for a very long time. So the government has probably collected on their loans before and might not have been able to collect on them. Some of them might not have had jobs. They might not have had the government might not have been able to, collect those loans. And so we'll see some collections activity on those. But I would say the big wave of collections activity will probably hit when that default cliff arrives this summer, when the borrowers who, re-entered the student loan system repayment system in October 2024, but didn't make a payment, start defaulting over the summer. That's when we might see a big wave of collections activity. And that's consequently when this might start becoming a much more salient issue in the student loan space.
Yeah, and Preston, what are, give us a sense of like how big this is going to be. I mean, how many borrowers are involved in this here?
So there are about 35 million borrowers right now who are not enrolled in school, and just 12 million of those borrowers are actually making payments on their loans every month. So
Okay.
about 5 million are in default, as I mentioned. Another 7.5 million are delinquent, so they haven't been making payments. And then another 10 million are in forbearance, largely because of legal challenges to the Biden administration's Save Student Loan Repayment Plan. They're in forbearance until those challenges are resolved. But when they are resolved, those borrowers will have to be transitioned back into repayment as well, and
Hmm.
they could end up defaulting too. So there are, I would say, more than half of borrowers right now are not in a great position,
Yeah.
and they're not, currently making payments on their loans.
Yeah. Sarah, can you chime in here on kind of like the borrower perspective, for borrowers who are in this position? What is their experience going to be like?
Yeah, so right now, the collections that are happening are part of the Treasury Offset Program, or TOP, and that is the government's ability to garnish tax refunds, other federal benefit payments like Social Security and EITC. So the folks that are most likely experiencing this are people who have monthly payments coming from the government, again, such as Social Security. This was turned on largely after tax season, till many people have gotten their refunds already. So maybe a smaller group of people has been having their benefits garnished, but that doesn't mean that that's not meaningful for them, right? That right now, I think there was something that came out from Secretary McMahon that said that $58 million had been collected. That, if you do the math, if there's 5.3 million people in default, you might say, oh, that's $10 or $11 per person. But if you think about this much smaller group that has these monthly payments, it's actually probably a couple $100 from folks who are living potentially pretty close to the poverty line, and there aren't great protections in place. And so I think it's important to remember that the numbers we may be throwing out are small compared to sort of all people in default, but that this is a group that is particularly disadvantaged, that's struggling the most, maybe didn't get a return on investment from their higher education, was poorly served by a complicated repayment system, and then is stuck in a system that traps a lot of borrowers in default and traps them in debt for really extended periods and doesn't sort of give them a boost to get back on their feet and put them in a position maybe to even pay more in the future.
Yeah. Okay. So how about, secondhand effects? So obviously there is like the financial implication of having the wage garnish, your Social Security check withheld, but what about, your credit score? Like, is this a change for what's happening at that level too?
Sure. And I think that to Preston's point earlier, there are a couple groups we're talking about here, right? There are people who are already in default, and many of them have fairly low credit scores. Their credit scores are dinged when they go delinquent. There's a second group of folks who are en route potentially to default, and those are folks who are having the biggest credit score implications now as they're moving through the stages of delinquency. And another point is that we do know a fair amount about the folks who are already in default. Those who defaulted before the pandemic, as I mentioned, are much more likely to be in a group that was not served well by their institutions, to have low incomes and actually low balances. But the difference with this group that's kind of coming over the horizon toward the cliff is that it includes a much wider variety of borrowers. It's people who entered the pandemic or entered repayment during the pandemic, folks maybe with higher credit scores who wouldn't typically default. And so the real challenge is, how do we reach and prevent this while also providing tools to help those stuck in default get out?
Yeah. Alex, you sit in a position right now representing a collection of institutions. How have institutions received this news, and how do they feel about this change in policy?
I think it's important to keep in mind that for institutions of higher education, they haven't touched or seen these students perhaps in many years. Now, that doesn't mean that the student doesn't feel close connection to their institution of higher education. They will oftentimes give the financial aid offices a call or somebody at the institution to ask for help. Since the department made its announcement in late April regarding the return to collections, it followed up and reminded institutions that they have an obligation under the Title IV, the federal student aid programs, to make sure that their borrowers are aware of their obligation to repay that debt. And the department also reminded those institutions of higher education that they are going to be beholden to the cohort default rate. And now this is a mechanism instituted by Congress that holds institutions accountable if a significant number of their borrowers default within the 3 years of leaving the institution. So while we don't see, this is still the federal government we're talking about, nothing happens immediately overnight, but I do think it's, for this quote unquote cliff that we're talking about today, it is going to be a slow moving thing where different stakeholders involved in the federal student aid system will feel different pressure points at different times. And so Sarah's already mentioned that credit reporting started where people that are delinquent on their debt, they started seeing that I believe in January on their credit checks. So they have been able to pick up the phone and call a servicer and say, hey, I noticed I'm delinquent on my debt. What can I do to get out of that? For some of these borrowers, as Preston mentioned, that are already in default, they've had a number of opportunities in the past, whether it was Fresh Start, to get out of default. And the department's announcement only kickstarted what will be a very long process using both voluntary and involuntary measures to start collecting undefaulted debt. So there's a number of processes that the federal government has to restart, and that should give borrowers some lag time to get current with their payments. So I think while we're very concerned and watching carefully how this process will play out, nothing, like I said, happens overnight. And so we anticipate that there's going to be lots of opportunities between that announcement on April 21st and the most significant of consequences for borrowers to reach out to those that can help them, whether it's the default resolution group, their guarantee agency, their lender, their servicer, their institution even, to figure out what information they need to come back into an active repayment status.
Yeah, so it sounds like you're saying, yes, you call it a student loan repayment cliff because that gets eyeballs on this event that you're hosting, Beth, but maybe this is more of a slow moving, snowball that's, potentially growing, but also there's time to address the challenges as they come up.
I think that's right. And it's no secret to those who watch federal student loans closely that there's going to be a lot of people that enter default. The federal government for years has been estimating that their lifetime cohort default rates will hover around 25%, depending on the year, the lifetime cohort default rates, not that 3-year cohort default rate, the lifetime. And when you think about years of non-repayment because of the COVID-19 pandemic, when you think of a whole year where there was an on-ramp, so there's no negative consequences for non-repayment, that's 4+ years where individual borrowers didn't have to interact with the system.
Mhm.
And when that happens, you're going to have a lot of people that, because they're not in regular contact, might end up estranged from the system. And so I wouldn't be surprised if we see, Preston already laid out those numbers, of 5 million people in default, another 7.5 in some sort of delinquency. That would make sense with what the federal government has long said their default rates could look like long term.
Yeah, and so, you're kind of articulating this division between the problem of student loan affordability driving these defaults versus like just this information or like a friction problem. Those seem like two distinct challenges, and I wonder, how like what are our mechanisms or policy tools for like addressing the information challenge? Because I think the affordability feels like more of an economics problem that we can solve with numbers and dollars and cents, but how do you fix that information problem when you haven't gotten students to log into their servicer accounts for 5 years? And what are we doing and what can we do to fix that?
That's the big challenge right now. And I think it's an all hands on deck situation. And so while student loan servicers have been calling borrowers, they've been sending them communications, there are other partners involved in the system which are stepping up. And this is why you see Education Secretary McMahon reminding institutions that they need to tell their borrowers to repay their debt. Institutions have a role to play, servicers have a role to play, and borrowers themselves, when they get these communications, these directives, need to answer the phone or they need to contact those that can help them. And so we see that there's going to be this long tail here, but there are tools and people ready to help borrowers in their moment of need.
Yeah, and I want to ask Preston in a minute about what safety nets remain in place following, all the dramatic changes that we saw during the Biden administration. But Sarah, I want to ask you, as someone who has previously worked at the department, I assume you're not a big fan of like a lot of the staffing cuts that we've seen from the reduction in force. That's just a wild guess. We haven't talked about that. But what do you think about the potential for those staffing changes to affect what Alex just described as really the solution here, which is like needing somebody to answer the phone, to help these students, these former students, I should say.
Yeah, that's a good guess. I am not a huge fan. I think to use Alex's language, this is an all hands on deck moment, but many of the hands that would have been on deck have been fired, have been encouraged to quit, are no longer there, right? And I think there are several groups of folks who I think are particularly notable. There has been a lot of press around some of the oversight groups that have been cut, and I think that's certainly important. That's making sure the people who, the contractors, the servicers, those engaged are following the rules, doing the right thing. But I think the other folks who have been cut, there's a lot of operations folks and strategy folks and people with just a deep knowledge of all the inner workings and the systems that are at play. And that just means that there are fewer people with deep subject matter knowledge, with deep experience, and who are able to project manage and think through. If you think about it, a contractor that comes in isn't going to up their own budget, right, to staff the call center differently or better. That's a decision that comes from folks who engage on the contracts front, people who think about sort of the long-term strategy of call center operations. And a lot of those people are no longer there. So you have this sort of recipe for lots of changes and uncertainty in the system, a pretty big change in terms of people being back in a state where they're going to have garnishment of various benefits that, payments are turned back on, collections are turned back on, and they're going to be looking around for help, and that may be harder to find.
Yeah, fair. Well, let's be optimistic for a moment and suppose this new streamlined, dojified labor force at the department is going to be hugely effective in being able to execute this. Preston, tell me what remains in place for protections for borrowers, because a lot of times I'm talking to people who are seeing this headline and they think that, because President Biden's SAVE program is not expected to go into effect, that borrowers really have no option. So where are we on safety nets that remain?
Well, I do want to be clear that it's almost certainly going to be the case that SAVE is dead. That super generous income-driven repayment plan, that's not going to happen. Either the courts are going to strike it down or Congress is going to repeal it. So nobody should be, depending on, SAVE being available. But there are other safety net programs out there. So there are other income-driven repayment plans that exist today that you can apply for today, which will tie your payments to your income. If your scheduled payment is too high, borrowers can submit an application for income-driven repayment to lower their payment to a reasonable share of their income, which can sometimes be as low as zero. The issue is that inexplicably, the Biden administration stopped processing applications for income-driven repayment last August. And so this big backlog built up of almost 2 million applications for income-driven repayment. I assume probably some more of those are going to come in now that collections activity has resumed. And so the Department of Education is trying to clear that backlog right now. I think they are making some progress, but, as Sarah mentioned, with some of the hands on deck being gone, that might somewhat limit their ability to actually process those applications. But those safety net programs, they do still exist. Borrowers who do want to repay their student loans, but might be seeking a more affordable payment, should certainly try to avail themselves of those options.
Preston, I was calling on you to give me something optimistic, and you kind of continued Sarah's doom and gloom, but I'm going to give you a pass on that. Let me bring in a question from our audience. So, first question is, if this return to collection is mishandled, do you expect it to shift the Overton window on student loan cancellation or solidify backlash against it? Good question. I'm not quite sure which direction the questioner would like us to move. But I mean, how does this change the politics? I mean, if this turns out to be a bit of a mess, which, it's looking like it is, and is there a version of this that wasn't going to be a mess or won't be a mess? Thoughts on that?
I think it depends on what you think a mess is. When it comes to this national conversation we've been having for some time over obligation to repay and forgiveness, I don't think that however the department handles this return to resumption or the resumption of payments and defaulted collections will change the politics of this. I think both political parties have put their flag in the ground and have said what they believe. And so a gross overgeneralization is that those in the Republican Party believe that these borrowers took out a loan backed by taxpayers and they have an obligation to repay. And these borrowers, despite a lot of legal challenges, despite the craziness of the pandemic, have every single available tool to them that they had under the Obama presidency. There's no reason why, given the generosity of income-driven repayment plans, given 33 different deferments and forbearances, given all of these other ways that we are trying to help borrowers repay, that these borrowers shouldn't be repaying in some form or fashion. On the Democratic side, and I invite others to contribute to this, there is a great concern about those that are perceived to be left behind by a system where they primarily those individuals from marginalized backgrounds who are attempting to get education to improve their life, and for whatever reason weren't able to complete that education and succeed. And in those cases, how do we extend that generosity? How do we make sure that those individuals aren't drowning in student loan debt for years and years and years? And there again, Preston pointed out that there are some income-driven repayment plans with $0 payments. And so there's this tension inherent in the policy when you're going to be this generous and try and finance higher education access through a loan program, you're going to have a certain amount of tough outcomes for people who default. And the question now is, how do we address those people? And I think that that's being teased out in Congress right now, and they're trying to figure out the best way to solve that problem.
I do think that there is, Alex, you mentioned the sort of idea that folks are getting left behind, and there are aspects of the default system that are particularly punishing, right? You can get stuck there. There's an element of the system called acceleration, where you enter default and the amount that is garnished from you can be up to the entire amount you owe, completely, not just the amount you would pay each month, which can force people, you can have a very large portion of your EITC taken, right? And so I am thinking about this both in terms of making sure that the policies in place are balanced, but also that there is an opportunity for people to get back on their feet, right? That they're not sort of penalized and punished so much by the system that they're stuck there, and we're sort of, what is the metaphor? Like squeezing blood from a stone. I'm sure I'm getting that wrong, but that there isn't more that folks can give, and it really is eating into their economic security, but then they also can't get out. So they're not making progress. And I think there are some reforms and some tools that could be put in place to assist with that. But I think the important thing is not that, I would say we should never collect, but that we should make sure that there are reforms to the default system so that it isn't so extremely punitive.
Can you talk more about that, Sarah? What would you like to see in particular? And are these things that the administration could do unilaterally, or do you need legislation?
There's a smattering of things, and they, as you can imagine, they fall in all shapes and sizes in terms of legislation, administrative, regulatory. But I think there are a couple, I think a really important tool to have in our toolbox to keep people from defaulting is the ability to automatically put them into an income-driven repayment plan if they go delinquent. So right now, I will not get into all the nitty-gritty details, but you can give permission to the department to work with the IRS to pull information you've already given to the federal government into your income-driven repayment application to make applying easier and to automatically recertify every year. But if you've given that permission, maybe sort of upfront when you're taking out your loans, presumably the department could and servicers could automatically put you in one of these plans, especially if you don't make a ton of money and you're eligible for a $0 payment. I think that is incredibly important. We know automation is a key to sort of in the behavioral economics realm toward moving people toward avoiding the most significant consequences. But I also think the TOP program, the Treasury Offset, where all the garnishments come from, really right now, if you are getting a Social Security payment, the amount that's protected from that garnishment is only $750 a month, which is about 60% of the federal poverty level. When that policy was put in place many moons ago, that was actually above the poverty level. And so we can actually push people below the poverty level taking their federal benefits. And so the government has decided, and often on a bipartisan basis with some of these, that people should have access to benefits if they are disabled, if they are, seniors, et cetera, et cetera. But then we're also taking that money away with the other hand, right? So really right-sizing some of that, even adjusting that to the current poverty level, to the current IDR amount, is something that the Biden administration had started to put in place. And my understanding is that that was stopped, although someone should correct me if that isn't right.
And Sarah,
anymore, but
correct me if I'm wrong on this. As I kind of think back on the history of income-driven repayment and this conversation about automatic enrollment of borrowers into these programs, I seem to remember that on the left, this is something that there was actually concern about 10 years ago, which was, that we don't want to automatically put borrowers into extended repayment plans because they'll end up paying back more interest. I mean, it sounds like, is that something that's shifted, or am I misremembering?
I think there's maybe a slight nuance there, which is instead of automatic enrollment of everyone, it's
Mhm.
automatic enrollment of folks who have become delinquent on their loans past a
Okay.
certain amount, right? I think the most recent
Sure.
proposal that was moving forward was 75 days, which is before the first big credit hit, but after you sort of demonstrated that you've been, a month, 2 months, and you're not self-correcting, right? Maybe that's a signal, and for many people, it is a signal that you are in some sort of distress, you have, maybe lost connection with the system. And so I think that's a really important, I think it's one of the most important things we could do to prevent defaults. We can do communications, there are many tools in the toolbox, but as we know from other fields, automation is an incredibly powerful tool.
Yeah.
Beth,
Yeah.
you asked me for something optimistic earlier, and
Yes, please, Preston. Come
I just
on.
want to build upon what Sarah said that, we coming out of this 5-year payment pause, we do have a little bit of a blank slate to try and fix some of these problems. If the collection system has not been turned on for 5 years, maybe this is an opportunity to rethink some of the ways we've done collections in the past, and
Mhm.
that we have, dealt with borrowers who have become delinquent on their loans. I still think that we do need a way to involuntarily collect the loans if borrowers don't pay, because otherwise there's no disincentive to not paying. But I think some of the ways that we've done that in the past with some of the excessive fees and, taking the earned income tax credit of people who are, very poor, that's not necessarily been a productive way to go about collections. And so I would hope that, the Trump administration might take some of these suggestions to heart and think about, okay, if we turn back on collections, maybe there are some ways that we can do this differently to make it a little bit less punitive, and also give borrowers a little bit more faith that, if you re-engage with the system, the student loan system, we're not going to punish you unnecessarily.
Mhm. Sure.
I think key to this, though, and we've rightfully focused on what I would consider to be the worst case scenario, which is the Treasury offset program. But barring these involuntary collections, there is a voluntary way out of default, whether it's rehabilitation or consolidation. And before the pandemic, there were dozens of private collection agencies under contract with the Department of Education to help borrowers through this process. And I just think, unfortunately, because of the way that things played out over the last few years, there are no private collection agencies currently under contract with the Department of Education, at least directly. There are maybe some that can help with the default resolution group or through the BPO system, but primarily all of those entities are exiting the system. And so if we're talking about the best way to help borrowers get through, consolidation and rehabilitation are going to be heavier lifts because those systems aren't in place as robustly as they used to be. And so to Sarah's point earlier, there's a lot that can be done um, um, moving forward that doesn't necessarily have to include garnishing wages or taking Social Security checks. And I look forward to figuring out ways that we can get that system revitalized.
Yeah. Let's shift gears a little bit here. We're obviously seeing some big changes come from the White House, but also the Hill is generating a lot of action on higher education at the moment. How do you think Congress should or will respond to, the changes that we're seeing in collections that are being directed by the White House? Was this a welcome move? An unwelcome move, and how will future congressional acts support or work against this effort?
I think that there's been immediate response that you can see in both political parties. And so you've got a bicameral bill introduced by some Democratic members of Congress called the Ending Wage Garnishment of 2025 Act. And so this, I think, gets to Sarah's immediate concern about some of the ways that the federal government collects on defaulted student loan debt. And this is those members of Congress' effort to make sure that that particular method does not continue or does with significant guardrails in place that are different than the ones today. On the Republican side, I think that there's a couple of things that we can see from the most recent budget reconciliation proposal from the House Education Committee. They do two things that I think are really notable. One is that they invest $500 million in 2 consecutive years to student loan servicers. And this is to help make sure that if people have questions and they want to give them a call, that there's somebody on the line knowledgeable and can help them out. And I think that that's you get what you pay for. And if you want a high quality student loan servicing environment, this is the Republicans' way of making sure that that exists as we transition back to a fully active repayment environment. The other thing that I think is notable for this conversation is they do allow, contrary to current practice, you are not able to get out of default through the rehabilitation process, which is 9 voluntary payments over a 10 on-time payments over a 10-month period. You can't go through that more than once to get out of default. And that's the only mechanism by which the default gets wiped away from your credit score. The Republican proposal, at least on the House side, allows borrowers to go through that process twice. And given the number of people that redefault, given the confusion over the system, that could be a really borrower-friendly way to help make sure that people not just get out of default, but get through it and don't suffer as many adverse consequences as they currently do. So I think that those two policies are notable as we move forward.
I think
Yeah.
too, part of the, oh, can I jump in?
Yes, please.
Part of the reason the default system is so complicated is because it's governed by multiple laws, and not all of which are overseen by the authorizing committees that folks in the higher education space are accustomed to working with. And I think traditionally there has been maybe less interest on the Hill in engaging on default related policy. Some folks have, but it has been sort of much less popular than some of the other student loan related provisions we've seen as of late. And so to Alex's point, there's a lot of daylight kind of between these proposals. One to suspend the ability to do various garnishments, and one to provide an additional pathway out of default. I think they're both important, but I think it really shows that folks on both sides of the aisle are thinking about this, thinking about it from a legislative perspective. And there, to me, that's sort of an implicit acknowledgement that the system is complicated. There are things that need to be done to improve it. And that's something that we really haven't seen if before, maybe not in a while. And so I think that, I hate to use the word positive because I think this large numbers of people in default is not positive, but getting the attention of folks, some of the things in the default system can only be changed legislatively. I think it's important that this is on people's radar.
The other aspect of this I want to kind of highlight is the optimal solution here is you stop making loans that are likely to default in the first place. And I do think the reconciliation bill does a little bit on that front. So they have a new policy which would basically hold colleges accountable for a portion of payments that students miss that they don't make. And I think the idea behind this is to disincentivize colleges from dispersing loans in the first place that students are very likely to default on, for instance, for programs with very low graduation rates or that have excessive debt burdens, tuition burdens, relative to earnings. And there's a lot of debate to be had about accountability. I don't want to necessarily turn this into an accountability conversation, but I do think that there is some recognition that demonstrates among Republicans that, not all of these student loans have always been made in a good way, and that we want to address the root of the problem, which is we want to stop making quite so many loans that are probably going to end up in default.
I think it also moves some of the discussion away from what I think can be a harmful sort of personal responsibility angle, where to sort of looking at the system and seeing where it has failed students and borrowers. Certainly ultimately the responsibility is on the borrower. That is the person who has the credit score damage and who has money coming out of their paycheck. But really wanting to make sure that schools are providing credentials of value, and that, we see a lot of folks who default are those that didn't complete and who maybe attended poor quality programs, at various institutions. So I think it's important really to think about this as a systemic issue, that we're never really going to solve this unless we pick the pieces in the system that are really not working for students and borrowers, and think about this more holistically.
Yeah, I completely agree with that. And I was just sort of rewinding in my mind to the beginning of COVID when President Trump made the decision the first time to pause collections. And I, screamed and, with my hair on fire. And I thought it was a terrible idea, in part because I anticipated that, we would see the kind of policy follow that we did, which was this extension and then the resistance to restart. But I think the fact that there was even calls for repayment to be put on pause in the first place reflected what people perceived as deficiencies in this overall program, like you were saying, in this very general sense that we need this program to work better for Americans. And since it wasn't working great, we don't want it to not work great while they're also in economic distress because of the COVID pandemic. And so, fair enough, when we zoom back out, to talk about what are those fixes that we need to see to make this work well. I mean, obviously, my hope is that this is just a speed bump in getting back on track with a functioning lending program. And my hope is that Alex's more optimistic view that this is kind of like a rolling problem and we can make some fixes along the way. I hope that that's accurate. But zoom out for me. And, Preston talked a bit about the risk sharing portion of the higher ed reform that is potentially coming through reconciliation. But what is in the reconciliation plan that can make this all work better? Can, create that more functional system that Sarah was just calling for? And broader picture than that, even, I mean, what do we need to do to make this all work well, to make student lending work well so that we don't get a public outrage that, loan-based financing of higher ed is the wrong way to go? What are the big fixes? Let's think big for a minute here.
So one of the biggest fixes is trying to overhaul the income-driven repayment system. So, the Republican bill recognizes the value of income-driven repayment, that, some borrowers do experience hard times, their incomes fall, and that we need to have a safety net for them to make lower payments during those times when their incomes are lower. But I think it fixes some of the problems that have kind of plagued the current income-driven repayment system, namely the interest accrual. So, if your payments are lower because they're tied to your income, sometimes that means they don't cover interest. And so you can pay more in the long run because you're seeing this interest accrue month after month, and you actually see your balance rise even though you're paying your loan. And I think a lot of borrowers do look at that state of affairs and they say, hey, I've been paying my loan for years and years, and yet my balance is still rising. What gives? And I do worry that a lot of borrowers find themselves in that situation and say, I'm giving up. I'm not gonna pay this thing anymore. And so the reconciliation bill tries to address that by if a borrower enrolls in their income-driven repayment plan and makes on-time payments, they waive unpaid interest so that your balance won't go up as long as you're making those on-time payments. And they also provide a credit to your principal if your payment is not enough to pay down your principal, so that you will see, as long as you're keeping up with your payments, you will see your balance decline month after month. And I think more than anything, that will go a long way towards restoring some of the trust that's been lost in the student loan system. That we have seen borrowers lose faith that the system is actually going to work for them. And if they do see that their interest is not accruing unnecessarily, and they do see their balances going down month after month, I think that will go a long way towards fixing some of the trust problems that we've seen arise here.
I'll say that a lot of what Preston has talked about in terms of the need for accountability and the need for a streamlined and simplified repayment system, I completely agree with on principle. I think he and I, there may be some daylight between us and some of the specific policies, but I think in principle that makes a lot of sense. I do want to double down on something Alex mentioned earlier, which is money in the system for the Office of Federal Student Aid. This office has been flat funded for the past couple years and has just like a breathtakingly large amount of things to do, large operational things, FAFSA, student loan repayment, oversight of institutions. And so, we talked earlier about problems with staffing, which, I made my feelings known on that earlier, but I think money will be is necessary but not sufficient, but will be incredibly helpful. I think he said something that's very true, which is that you get what you pay for. And so we certainly, of course, need robust oversight over our federal contractors to make sure that they are moving programs forward, following the rules in the way that is in the best interest of borrowers. But we also need to make sure that there are people there, again, to answer the phones, to be able to provide assistance. We need all of those resources and tools. And so I think an acknowledgement that there really does need to be more money in that system, within an effort that is slashing a lot from the system, I think is important.
Beth, I think you asked the $1.7 trillion question, and I'd like to put forward two other things that may be useful and could shock the system. One of them is harder to do in budget reconciliation than the other, but I think it could go a long way. One of my favorite surveys or studies that I saw, and it's dated, but was done by Beth in the mid 2010s, and you looked at borrowers and how closely they knew like how much they had borrowed. And it was something like 12% of people that you had verified had federal student loans had no idea that they had a student loan. This suggests that something is very, very wrong on the front end. And a lot of these downstream things that we're grappling with today, I would argue could be solved upstream with better financial counseling and a better understanding from the get-go for students and families that are trying to access higher education. A lot of people, and rightfully so, they know that higher education in general can be a good bet if they complete and earn a degree. And so they say, I'll sign on the dotted line. I know this is what I need to do to access college. And I think a lot can be done there to educate people on what these what could happen if they take out a loan, or maybe that there's some alternative ways that they could get the financing they need to complete their program. I think that that would be a remarkably good thing, because right now entrance and exit counseling clearly is not as robust as it could be. It's hard to do in budget reconciliation because it doesn't necessarily have a budgetary impact, although I think that there's some creative ways to do that. The second thing that I think could be really interesting, and I'm not endorsing this, but we haven't yet talked about bankruptcy. And I know a lot of people have thought long and hard. So opposite end of the spectrum, not people accessing college, but people have long left who are continuing to struggle with their student loan debt. Ideally, this is what income-driven repayment plans are for, to help out those struggling borrowers. But there has been bipartisan support in the past for taking a look at how we treat borrowers with federal student loan debt, and whether there is a point in time where maybe they don't have to meet the same hardship definition because they have tried and tried and tried and clearly are in this gaping financial hole. And so I think that those two things, although they're not currently in the reconciliation proposal that proposed by the House, there is some room to consider these things. It's not unheard of to put those forward. And I think that just the last question, and it's one that policymakers are grappling with, it's not necessarily policy specific. It's like, what kind of federal student loan system or federal student aid system do we want? It sounds as if we want Pell Grants to help people access college. I think the question now is, do we want student loans to be an access tool or a completion tool? And I think that that's where the conversations now go.
Expand on that, Alex. Access versus completion, and then Sarah, I want to get you on the same issue.
Well, what I mean by that is we want students that are from low-income backgrounds to access college, but what are they accessing? And there's like a certain amount that it sounds like we are willing to have federal taxpayers bankroll. If you're low income, you'll get X thousands of dollars in Pell Grant based on your student aid index. But when we're talking about loans, there's a less of an interest in making sure that that money can just go out the door with no questions asked. When taxpayers are lending out or backing these loans, Republicans are increasingly asking, what is the return on investment, not just for the taxpayer, but for the student? Let's make sure that if institutions are raising their prices because there's this widespread loan availability, that they're doing it for students that are in programs that economically benefit not just the student, not just the taxpayer, but broadly the community. And I think that is a sea change in the way that we've talked about federal student aid historically.
I will say that the current House bill does make some pretty significant cuts to the Pell Grant program, especially for folks who may be attending, less than part-time, people who have caregiving responsibilities, potentially have to work, have children of their own. And it also creates this, median cost of college system, which I will not explain. It's very detailed, but that can make it really hard for folks to understand and predict the amount of how much things will cost, how much they can borrow from year to year. So I think that it is important to provide resources both in the form of grants and loans to people. It also eliminates subsidized loans, which are loans made to those with the most need. So I think it's important to make sure that resources are there for the populations we want, but also that the system is understandable and predictable. and it's, and people's ability to plan, to your point about, financial counseling, to understand how much something's going to cost, to be able to both plan for their college experience, but also to, as they're doing that, anticipate what repayment might look like.
Yeah. Let me link that to a question that came in. I think this was on Twitter, regarding, this affordability and link of eligibility for lending to labor market outcomes. The person asked, should federal lending be more tightly linked to projected labor market outcomes, and what are the risks of that sort of approach? Alex, it sounded like, you were moving in that direction, and what are your feelings about that?
My personal feelings are probably different than policymakers, and I think policymakers in DC take precedent. But what I would say here is, historically speaking, we've relied on the federal government to support broadly a higher education sector that has been an engine of economic mobility for a lot of students. And the question now that we have more granular data is, that doesn't seem to be the case for every academic program. And in a world where we've got rapidly changing technology, a rapidly changing demographic society, we have to take a look, broadly speaking, and figure out, is a loan program financed by a federal taxpayer? How much are we willing to lose as a society because of all of the economic gains that come about from it? And increasingly, it looks like we're willing to take on some risk still, but it can't be a spigot wide open the way it's been for the last few decades. And I think that's the tension, is there's, for the first time in a long time, it appears as if Republicans want to make sure that, that faucet isn't running wide open. And I think that that's going to be a real challenge. And it's up to other actors in the system, whether it's states, private philanthropy, foundations, to fill that gap. It doesn't necessarily have to be the federal government which steps in. If there's truly a society benefit to having students access some of these programs, there are other people involved in the system that can help make sure that students can continue to access and complete these kinds of programs.
Yeah, and worth pointing out that so much of what we know about program level returns is thanks to some work that Preston has been doing over the last several years. So kudos to you, Preston, for contributing that way. And Sarah, I want to get you in on that same question. We've used access to debt as an access tool. People on the right argue that this is a wrong mechanism. What are your concerns about, linking to labor market eligibility for debt to labor market outcomes in this way?
I think to sort of use Alex's metaphor, when you have a faucet of, money in the form of loans, that isn't just going to students, but it's also going to schools, right? So loans to students are essentially, way overly simplify it, grants to schools. And so I don't think that it is unreasonable to have some sort of expectation that says, if someone completes your program and gets a bachelor's degree, they should, for example, earn more than someone who just has a high school diploma, right? I think, is able to have a wage that supports the debt they took out. And there are many, many flavors of this going on right now, many conversations about how to do this, but I don't think that's an unreasonable expectation.
Okay, that's great. I think we found one point of relative agreement on the panel today, so that's good. Let me see. Let me take a look. Okay, one more question from the audience I wanted to pose, and I think it's a really good one. I've learned over the years of studying student loans, there's the economic questions about it, and then there's the behavioral side of things. And if you ignore the behavioral side of things, you miss so much about this world. And so the question asks, what behavioral lessons have we learned from this long pause, such as borrowers' response to uncertainty or lack of communication? And how could these shape future policy? I think a great one.
It's not exactly what the question asked about the pause, but I think one thing that I've learned behaviorally is that, when we talk about, as economists, we say, oh, well, the returns to a college education, assuming you went to a good program and actually graduated, are lifetime. So, we should extend out the repayment timeline by, having an income-driven repayment plan that extends over 20, 25 years or so. And so there's payments kind of in your later earning years. And it turns out students hate that. It turns out that borrowers actually want to be done with their student loan obligations as quickly as possible, for the most part. We actually see that there's a cohort of about 25% of undergraduate borrowers that actually pay off their loans within just 5 or 6 years. They just throw as much money as they possibly can at their loans to just be done with the obligation as quickly as possible. And so I do think that some of the policy instinct over the last 10 years or so has been to try, let's lower payments, let's extend out the repayment timeline, because then we'll align it more with the returns to a college education. And that
And it
makes
makes
sense
good economic sense, right,
that
Preston?
makes sense from an economist's perspective, but it turns out that on the behavioral side of things, borrowers don't really like that. And so I do think that we do need a little bit more thoughtful policy that does take into account some of those behavioral aspects of borrower behavior.
Yeah, that's right.
The other thing I'll say is that I think it's become even more clear that Americans live one financial life. I think we often think about our policies in silos, but when people sit down at their proverbial kitchen table with their family to talk about finances, it's not like on Tuesday they talk about higher ed, and on Wednesday they talk about childcare, and on Thursday they talk about groceries, right? These are all things there are trade-offs that are happening. And so I think it just points to the importance of getting the formulas in an income-driven repayment plan right, where they're matching up with sort of the elements of people's lives that are going on in the background that are supportive of those with the lowest incomes. And people thinking, we're seeing this, like a lot of folks who maybe have become disconnected during the 5-year pause, or I guess the 5-year pause in collections, right, maybe have their budgets assigned to something else right now. And so this isn't sort of for a lot of people, sort of a totally intentional and willful neglect of a responsibility, but rather, how humans think about the resources they have in front of them. So making sure that the programs we have meet people where they are, instead of, expecting people to absorb every single weird nuance about the loan system, which at the end of the day works totally differently than the other bills people have. And so I think it just really underscores needing to make sure we get the details of the policy right.
Well, and I think the behavioral question is an interesting one, especially because as Sarah hit it exactly correct, which is if I'm a family and I don't pay my cell phone bill, there are consequences to that. If I'm a family and I don't set aside money that I need for groceries, there are consequences. If I don't, pay for, medical health care that I need, there are consequences. What are the consequences for not paying my student loan? Over the last 5 years, there's been absolutely nothing. And so if I'm a family and I'm looking at my budget, all of a sudden the last 5 years has meant that I can spend, anywhere from 1 to 5% of my income more towards some of these other priorities. It's not, and so I think that's actually one of the benefits of a collection system, or a federal student loan system fully re-engaged again, where it's real for borrowers. Again, after years where there's maybe forgiveness, maybe there's not, maybe there will be a credit check, maybe there won't be. This makes it real, and families have to take a look at their budgets and go, okay, I took out a loan. This is a society-wide question. What do I owe the people that I live in community with? And I have this federal student loan that I need to repay. And so I think it's going to be a change in mindset for a lot of borrowers. But I have faith that a lot of people want to do the right thing. They don't want these negative consequences. And I think that there's going to be a lot of ways for them to avoid the most serious negative consequences. And it's up to policymakers and people listening on this call, and researchers and everyone else, to make sure that we re-engage the system in a way that redounds to the benefit of all of these various stakeholders.
Great, that's helpful. I'm going to ask each of you to answer one final question for me, and then I'll let you have your evening back. But this one is also from a listener who said, basically, what is your priority as somebody who lives and breathes in this world? What is the one thing that you feel like is critical to reform? If you could have that magic wand and fix one thing, what would it be?
I would say we need to recognize that, while the value of higher education is positive on average, An average is just an average, and there's a lot of variation there. There are a lot of times where people pursue higher education and it really doesn't pay off, whether it's they pay too much for their degree or their degree is in a field that's just, simply doesn't pay very much, or they fail to graduate for various reasons. And that those cases, I think, are a lot more common than we've really appreciated in the recent past. And I think a lot of the problems with our student loan system ultimately stem from that. That if you did not get a good deal from your education, it's going to be more difficult for you to pay back your student loans. And so we can talk about all these changes, on the back end, and which I'm, very supportive of, that we do need to fix a lot of things about on the back end about the repayment system. But we also need to fix things on the front end. We also need to make sure that the federal government's being a little bit more deliberate about, when does it make the student loan? Is that student loan that it's making always going to be a good deal for the borrower and for the taxpayer? We know it's going to be a good deal for the school, but is that going to be a good deal for the student and for taxpayers? That's not always the case. So, until we fix the origination of loans on the front end, I think we're still going to be, having this problem.
I could wave a magic wand, I think the one practice that I'd like to focus on is how do we make going to college, trying to go to college, a less risky proposition on the front end? Because I think that's where we see a lot of the downstream consequences that we've been talking about today is borrowers or students who try and go to college because they hear overwhelmingly that college is your ticket to the middle class or your pathway to economic mobility, and it didn't pan out for them. And they did it with loans. And so I think finding policies to make that first year in school less financially risky to the student as they try and figure out if this is the right pathway for them could go a long way to solving some of the student loan crises that we've been talking about. So whether that's maybe a larger Pell Grant in year one, or maybe all for additional years, maybe that's trying to figure out some other financing mechanism to make the proposition of going to college less risky. I think that would be key to solving a lot of the issues that students and families have been grappling with over the last few decades.
I like that. And Sarah will give you the last word.
I really agree on the importance of thinking about fixing things on the front end, and yet I will pick a pretty technocratic fix on the back end because I think it's possible now. I think there is some bipartisan agreement around it. It's just automating the process for people when they miss payments, making sure that they have that easy access into an affordable plan. I think this would do just wonders right now to prevent default. And I think it's something that within the current environment, it's possible.
Yeah, appreciate that. Thank you all so much for being here and for this conversation. I learned so much from each of you, as I always do, and thank you to the audience for joining us in this conversation today. We will convene again soon when the political and policy environment calls for it. Thanks for your time and attention, and take care.